So hi everyone, I'm Akshara Menon, analyst at PMS Bazaar. It's a pleasure to welcome you back to the webinar after a considerable break. I want to express my gratitude to each and every participant to join in for us PMS and AAF Summit 6.0, whether in person or virtually. We had a fantastic turnout of around 750 attendees at the venue and nearly 1,000 participants engaging through virtual platform. I also want to extend my thanks to the sponsors whose support was instrumental in making this event such a success. And without taking much of your time, today's top webinar topic would be Market Outlook, ASK Investment Philosophy, and ASK Growth Portfolio. To talk on this, we have Mr. Sandip Bansal, Associate Director. Hello, sir.
Hi, Akshara. How are you?
I'm good. To just have a brief about on Mr. Sandip is that he has joined ASK as a senior portfolio manager. He has over 18 years of experience. Prior to ASK Investment Managers Ltd, he has worked with SBI Life Insurance as the equity fund manager and head of investment research. He also worked with UBS Securities, Kotak Securities, KPMG, and Citibank. To talk on his education qualifications, Mr. Sandip is a CE and a CS person and has completed his MBA from IIM Ahmedabad. Over to you, sir. And before that, I would request the participants to put their questions in the Q&A box and not on the chat box, and also not to ask any stock-specific questions. Over to you, sir.
Yeah, thank you, Akshara. Hello, friends. It's a pleasure to speak to all of you today. I'm just sharing my screen. So, friends, we will be covering the market outlook, ASK's investment philosophy, and our ASK growth portfolio. So starting off with the market outlook, if we look at the returns that various markets have delivered in this calendar year or over the last 1 year, we will see that globally a lot of markets have done well, and India is actually somewhere, let's say, in the middle of the pack with CYTD returns of around, let's say, 8%. So it is not that only India has done well. There are many other markets which have actually done better than us. And obviously, there are a few which have not done as well. But if you look at a slightly longer term time horizon, more like a 3 to 5 year time bucket, then, we will see that India has actually outperformed the rest by a decent margin. So, India does and remains a good long-term investment story. Now, what has happened that has led to this global rally in equity markets, while the entire asset class has done well? So, there are three important things for equities to do well. It is sentiments, liquidity, as well as fundamentals. So we'll speak on each of these factors, more from a slightly near-term perspective. Longer term, obviously, the story for India remains good, we all know. So, first, speaking about sentiments, globally, what has happened is that inflation has eased off. So, in this chart over here, if you see, the dark blue bars are inflation levels in October 22, and the light blue bars are inflation levels in October 23. So if we look at it across US, EU, etc., inflation has come off meaningfully. This has aided sentiments for the equity as an asset class. Inflation, as we know, had reached multi-decade highs over the course of the last 1.5 years or so before it came off in last few months. What has led to inflation cooling off? Certain key drivers have been commodities, whether they are agricultural commodities or base metal prices, and to some extent energy prices as well. If we look at it from their 52-week highs, these have corrected by anywhere between 10 to 30%, and this has driven global inflation lower. If we talk about oil, which is one of the important commodities from an India perspective, especially, after a 34% kind of a run up that we had seen, let's say since June, it has actually come down by around 19-20% now. And gas prices, natural gas prices, which had become extremely high, reaching all-time kind of peak levels, let's say a year ago or so, they have also meaningfully corrected. So energy prices cooling off, especially in recent times, has had a good impact on inflation and the sentiments around equities. What has this done, this inflation cooling off? This has led to two continuous pauses by the US Fed, and the European Central Bank has also paused in its rate hiking cycle in the last meeting. Global central banks, especially the US Fed, basically decides the cost of capital globally. After one of the fastest increases in interest rates that we had seen, the Fed has paused, and the 5% plus kind of levels that we've seen for the Fed funds rate is actually the highest level since the global financial crisis. This pausing has basically signaled to the world that the cost of capital globally is stabilizing, and perhaps it could come off from here, which basically is positive for risk assets and long duration assets like equities. So in this chart, if you see, the dark blue line is the inflation line, while the light blue line is the US Fed funds rate line, and this is the ECB line. And we see that both of them have kind of paused and inflation has come off. If you look at the US 10-year bond yield, after reaching 5% kind of levels, which has been, let's say, the highest in the last 15 years or so, it has corrected to, let's say, more like 4.5% kind of levels, which has again aided global sentiments, and it has also signaled that the cost of capital globally has peaked out and could potentially, come off from here. The second aspect, which has been in favor for Indian equities is liquidity. While in the last few months we have seen FIIs selling, the domestic market continues to see good sticky money flowing in. So let's say, if you look at this data, the SIP data in India, equities are seeing an inflow of around, let's say, roughly around $2 billion a month, which has doubled over the last, 2.5 years or so. In addition to this money, we also have sticky money inflows coming from EPFO, pensions, and also to some extent insurance. So, the overall pool of sticky money that is kind of flowing into domestic equity markets would be, let's say, maybe a couple of thousand crores more than this number. So more like, maybe 18,000 crores plus kind of a number, which is aiding liquidity in the markets. The third aspect, which is positive for India in the short term as well, is that fundamentally speaking, India is going to remain the fastest growing large economy globally. So while the world economic growth rates are more likely to be in the 3% kind of a ballpark range, Indian growth is likely to be more than double of that. And there are not many large pools of economic growth that the world can tap into, and India is one of them. So it is quite likely that global funds, which also eventually chase yields, would have to come to India. So economic growth rates are good, but how does it translate into profit growth rate for companies as well as ultimately the markets? The growth rate that we are forecasting for profits of, let's say, Nifty companies is more likely to be in the mid-teens plus kind of a range. So maybe Nifty earnings are likely to grow more like 17% kind of levels over the next couple of years. So this good economic growth rate is going to translate into good earnings growth for the underlying corporates of the country. And obviously, what happens is that as profit pool expands, uh, share prices and market caps of companies also concomitantly kind of increases. So in this chart, friends, if you see, we've kind of put out the annual corporate profits and the market capitalization of stocks, and they tend to move in the same direction. So all the three key elements, which is sentiments, liquidity, as well as fundamentals, are in favor. Now, no discussion on market outlook is complete without a word on valuations. So this is a chart of Nifty valuations looking at EPS on a 1 year forward basis. So if we look at this chart, there are a couple of things that we can say. Firstly, we are here. So what we can say is that we are not definitely cheap. Very attractive levels from a valuation perspective would be maybe here, or maybe here. So, maybe 2008, 2013, or for a brief period in 2020. At these kind of levels, we cannot say that the markets are particularly cheap. But what we have seen in the past is that markets have actually traded at levels which have been higher than the current levels that we are trading at. So is there a potential for the markets to move higher than this? From a historical perspective, we can say that yes, they do have a potential. The other aspect to see from this chart is that, it is maybe makes good sense to continuously put money in markets, because it becomes very difficult to time the markets. How many of us would have had the courage or the ability from an emotional perspective to put money during 2008 or 2013, or for that matter, even 2020. So, from a valuation perspective, given the earnings growth outlook, given the liquidity support, given the good sentiments that are around, we could stay, at elevated levels. Obviously, there are different pockets of the market. We've seen a very good run up in small caps, also in mid caps. Maybe large caps could be relatively more attractively valued. Maybe there are some sectors which have seen a better run up than the others. So obviously that selection needs to be made on a continuous basis. What were the key takeaways from the results that went by in the quarter that concluded? So the investment side of the economy, or the capital expenditure side of the economy, continues to do well. We've seen good growth in that space. Domestic consumption has been a bit weak. Exports have been a bit weak. The financial sector has kind of delivered the numbers which were expected. On the other hand, chemical and pharma intermediate companies have witnessed pressures due to lower exports. The IT sector earnings have been muted, which was kind of expected. The pharma companies, on the other hand, have delivered results which were slightly better than expectations, driven by stable volumes, especially on the domestic front, while the lower input cost aided their margins. The auto sector, has delivered expansion in margins, delivered by, led by a lower input costs, and also operating leverage kind of helped them. The consumer discretionary sector, on the other hand, was a bit muted, and the reason for that, there was a shift in the festive season, which kind of impacted growth in this quarter, but obviously, it will kind of pan out in Q3 of the current year. Now, in net, summing all of this up, how do the markets look? So, management commentary for, during the second quarter was that there was a pickup towards the end of the quarter. So, from September onwards, there was a pickup. The market feelers that we've got on the ground also is that, the festive season has been good. We expect the capex side of the economy to sustain its growth levels. On the export side, things are expected to pick up more from the fourth quarter. Chinese economy, after opening up post-COVID, did not pick up as strongly as was expected. So there was a destocking cycle in China, because of which they dumped goods in many places across the world, which kind of impacted our exports. That is expected to kind of bottom out, and we are expecting good growth in exports from Q4 onwards. On the margin side, lower input costs will continue to aid margin expansion, in the second half of the year as well for most user industries. From a risk perspective, two or three key elements. One is we will have to be watchful of how the Rabi season pans out, because we have had some kind of erratic monsoons in Kharif, and so we will have to be watchful for Rabi to look at food inflation. And then there is this election calendar, which market would be closely watching to see whether policy continuity is going to remain or not. From the global side, geopolitical risks, both in Middle East as well as Europe, and how it kind of impacts the rest of the world, are the key monitorables. Now coming to ASK investment philosophy. So I just have this one slide on this, on which maybe I'll spend some time to detail how do we think about investing. So we basically have two key pillars for investments. One is capital preservation, and the second is capital appreciation. Capital preservation for us is most important because capital is the raw material for this business. So we go by the principle of safety first. It is only when we protect the capital that we have would we be able to remain invested and keep investing more. The second pillar of our investments is obviously capital appreciation. People come to equities as an asset class only because it has delivered double-digit kind of returns from an historical perspective. And if there is no appreciation, good appreciation in capital, then the attractiveness of equities itself will go away. So we work with these two pillars, and then we have a set of important parameters that we follow while investing. The first parameter is the size of the opportunity. We are very mindful of the sector within which we are buying the company. We want to buy businesses only in sectors or segments that are growing and that will continue to grow for a long period of time. So just to give you an example, friends, let's say maybe the publishing industry, or media publishing industry might not have very high growth rates going forward, because of the expansion that we are seeing in the digital economy. And hence, maybe that is a sector which we as investment managers might not be very inclined towards. That is not to say that, there will not be any opportunities in that sector to make money. It is just that our kind of investment philosophy would not look at that sector very favorably. We would rather invest in businesses that are part of a large growth pool, and that pool kind of keeps on expanding. The second pillar for us is earnings growth. So we generally seek a minimum 15% kind of an earnings growth from our underlying investment companies. And the reason for this 15% kind of a growth is that, let's say maybe the Indian economy is expected to grow at a 7% kind of a real growth rate. We want companies in our portfolio to grow at least 50% higher than that. So, that takes the rate to more like 10 to 11%. And then you add an inflation of around 4%. So, maybe a 15% kind of an earnings growth is what we are looking for. But for us, only the quantum of earnings growth is not important. What we also focus on is the quality of earnings growth. So we want from the earnings that they should be relatively more predictable, relatively more sustainable, relatively more consistent, and relatively more durable. So when we look at earnings growth, we basically do not look at earnings growth only for the next quarter or the next year. We look at earnings growth more from a 3 to 5 year perspective. And it is possible for earnings to grow in that time horizon only if the quality of those earnings are very good. The third aspect that we focus on is the quality of the business. The quality of the business is very important for us. When we say the quality of the business, is basically means that the return on capital of the business needs to be very good. The business needs to have a very good competitive advantage, and it will be great if that competitive advantage, or what is generally spoken of as moat, actually grows with a period of time. We want the competitive advantage to actually be sustainable. And we believe that the combination of a high growth business, which is very high on quality as well, is very potent, and that can lead to significant wealth creation over a period of time. Also, management quality for us is a non-negotiable. We believe that only quality managements are able to create high quality businesses that can sustain growth over a period of time. And obviously, the last but not the least, is the fact that we want a margin of safety. We do not invest at any price. We are very conscious of the fact that we need to have some discount to the fair value of a stock at the time of buying. So, these are the key principles and the key parameters that we look for at the time of investing. One more important aspect of our investments is that we invest for the long term. We do not invest money for short term. We, at the time of investing, we are more focused on, let's say, a 3 to 5 year kind of a time horizon than, let's say, a 2 quarters or a 1 year kind of a time horizon. There have been businesses in our portfolios that we've been holding on for a long period of time. And we believe that, all good things take time to build out, and good businesses also take time to build out. And we would like to think ourselves to be part owners of such good businesses. And when those good businesses build themselves out over a period of time, we as part owners stand to benefit from that growth journey. So this in nutshell is our investing style. We have one common philosophy that we follow across our ASK portfolios at the time of investments. And, this is a philosophy that we've been kind of following for a long period of time. And, it has held us in a good stead. Now, friends, I'll speak on to the about the last segment of our discussion today, which is ASK's growth portfolio. So ASK's growth portfolio is one of the longest PMSs in the country. And again, this portfolio follows the same philosophy of ASK of investing in high quality businesses that display high growth over long periods of time. This, friends, is a flexi cap portfolio, what is generally spoken in terms of market parlance. So there are no constraints in terms of market caps, while we do not actually select stocks on the basis of market cap. So we are what one would generally say market cap agnostic investors, in the sense that for us, a good business is a good business. It could be a small cap, it could be a mid cap, it could be a large cap. At the end of the day, it needs to create wealth. So, this portfolio, theoretically speaking, could be 100% mid cap or 100% small cap or 100% large cap. Obviously, there's a mix. Uh, this portfolio does not have any sectoral biases. So we can buy any sector up to any extent. This portfolio does not have any stock limits per se. Excuse me. But generally speaking, we we run concentrated portfolios of around 25 to 30 odd stocks. So basically, this is the portfolio which is at the meeting point of ASK's philosophy and the market in general. So the entire expanse of the market in terms of sectors, market caps, we can look at, and wherever there is opportunity to create long-term wealth, we would like to participate in this portfolio. Just looking at how do we go about selecting our stocks. So basically speaking, we start off with 500 top companies in the country. Then we apply a filter of a profit before tax of only 200 crores minimum. This is because that kind of denotes the size of profits and the fact that the business has reached a certain scale. So companies which have a profit before tax of less than 200 crores, we do not evaluate in this portfolio. So that basically gives us around 300 odd companies or so out of these 500 companies. So let's say maybe 40% of the companies are knocked off. Then we put in a subjective criteria in terms of management quality, which is integrity, vision, execution, track record, character, capital distribution, how they've taken care of minority interest, etc. And after this subjective evaluation, what we see is that another 50% of the companies are taken out of that list. So roughly around 150 odd companies remain. Then we apply two quantitative filters. These two quantitative filters are basically 15% earnings growth minimum is what we want, over a period of time, obviously. So generally speaking, 3 years. And we also want a minimum return on capital of around 25%. Basically, if we want our companies to grow at 15%, what we expect from them is that they should generate enough capital so that they are able to fund their own growth, so that they don't have to come either to equity markets or go to banks or the debt capital markets to fund that growth. So 15% earnings growth and 25% return on capital, we believe is a potent combination. Then, what we also look at is a margin of safety. We want at least a 15% kind of margin of safety at the time of investment, which basically leaves us with, let's say, broadly speaking, 100 or so companies to evaluate, out of which, we select around 25 odd stocks. So let's say between 25 to 30 stocks to build this portfolio. We aim to run concentrated portfolios. We don't believe in a very diversified portfolio strategy because we think that concentration only can lead to significant wealth creation. And what we believe is that these 25 to 30 companies are relatively strong companies in their respective sectors. So we do ensure that there is an eclectic mix of sectors and are mindful of the fact that there's not a big skew towards any particular sector. Generally speaking, the companies that come out from this methodology are companies which are in some sense leaders in their respective sectors, not necessarily market share leaders. They could be growth leaders, they could be profit leaders, they could be innovation leaders, they could be visionary leaders, they could be doing something unique, which we believe is going to lead to a lot of wealth creation. The bottoms up exercise of selecting stocks, which is focused on high returns on capital, high quality managements, good balance sheets, good free cash flow generation, and also good growth generally reduces the volatility in the businesses. And hence what we've seen is that the underlying beta of the portfolio has been historically lower than that of the market. So, the beta of the portfolio has been 0.8 since inception. Uh, Generally, the market beta is taken to be 1. So, any number lower than 1 is good. So, 0.8 is a good number for a portfolio. And historically, that has been the characteristic, which is a result of more the bottoms up stock picking exercise that we follow. And this, we believe, kind of supplements our pillar of capital preservation. To demonstrate the other pillar that we have of capital appreciation, this is the list of the portfolio stocks, and a green box basically highlights if the stock has hit a new lifetime high during that year. So generally you will see that most of the stocks have been hitting new lifetime highs each year, which basically means that there is capital appreciation as well. The blanks indicate that maybe the stock was not listed during that time. The zeros indicate that it did not hit a new lifetime high during that year. So this is also one of the parameters that we believe kind of strengthens the capital appreciation and capital preservation pillar. As far as capital appreciation is concerned, this historically speaking, these are the kind of returns that the portfolio has generated for us. This portfolio has been in existence since 2001. So this is over a 22-year kind of a time period. Now talking about the sectoral construct of the portfolio as of now. So roughly around 1/3 of the portfolio is present in the BFSI sector, the banking and financial services sector. Roughly around 1/4 of the portfolio is leveraged to the capital expenditure side of the economy, which we believe is a very high growth space as well. The BFSI space also we believe has a very long runway for growth. Then around 1/5 of the portfolio is comprised of the consumption sector, given the demographic profile, the large demographics, and the large youth composition and relatively lower consumption levels across various segments. We believe that there is a very large opportunity in this space as well. So, these three spaces together comprise bulk of the portfolio. Then the other key space for us is chemicals, which kind of leverages India's expertise for exports, as well as there is a very large opportunity for import substitution as well. Then there are other sectors like oil and gas, telecom, and pharma, which are present in relatively lower percentages. Portfolio composition obviously can keep on changing with time as we evaluate and find newer opportunities. This can change, but this is what the current composition is. If you look at it, generally speaking, the businesses that the portfolio is focused on are more domestic focused. The export focused businesses are relatively very less. Secondly, the component of commodity linked elements in the portfolio is low, because there is a lot of volatility in those businesses, and generally speaking, our portfolios are less volatile and more robust. Generally speaking, the businesses are comprised of the portfolio is comprised of businesses that have a very light balance sheet and are free cash flow generating. How has the portfolio earnings growth kind of panned out? So if you look at it, the portfolio earnings have grown at around 35% versus maybe 22 odd percent for the Nifty in the last quarter. Going forward as well, we are expecting the portfolio earnings growth to be higher than that of the market. Now, just coming towards the end of this deck, this is the key portfolio psychographics. So, if the portfolio was one stock, how would the key parameters of the portfolio look? So the return on equity profile of the portfolio is, upwards of 20%. The return on capital is upwards of 30%. The earnings growth is in the region of 25%. All of these parameters compare very favorably with that of the market. So they are, let's say the underlying market is likely to grow more in, let's say, the 17 to 18% kind of a range, while the portfolio earnings growth is more likely to be in the 24, 25% kind of a range. Similarly, the balance sheet profile of the portfolio is also very good because most of the businesses are free cash flow generating with low debt levels. The debt to equity levels are also close to zero. Consequently to all of this, relatively speaking, the valuation ratios look elevated, look higher versus that of the market. So, if we take Nifty as a FY25 kind of numbers, the P ratio of the portfolio would look maybe 25% higher than that. But we believe that because the businesses that are comprised in the portfolio are relatively large, stable, growing businesses that are in some sense leaders in their respective segments and subsegments, and they have demonstrated an historical track record of good earnings growth, good character, good managements, and very good balance sheets. This kind of a premium is warranted. It is not that we seek to invest in high PE companies. It is just that character does not come cheap. Good quality companies do command premium valuations, and we believe that the solid growth profile and return on capital profile kind of makes up and deserves these kind of valuation levels. So thank you, friends, for your patient hearing. It was a pleasure speaking to you, and would be glad to address any questions that you might be having. Thanks a lot.
Thank you, sir. Thank you for this elaborate. We get to understand about the growth, we get to understand about more about ASK's investment philosophy, and also more about the markets, of course. So I would like to thank you for that. And I will also, we have few questions to be asked. Moving on to them. So very first thing that I want to ask is that after Diwali rally, do you see this Santa Claus rally coming up early? And the big question now is that for the investor, should he stay, should he book profit or should he stay invested?
Sure. It might not be a very good idea to look at markets from such a short-term perspective. Equities is a long-term asset class. And when we have short-term expectations from a long-term asset class, it could result in accidents. Having said that, there are a few events that are coming up. So let's say, the earnings growth so far has been good. Festive season, at least the color that we are getting, has been good. So the earnings growth for FY24 is likely to be delivered. So, that is a positive that could come through. The ask rate anyways is not very high. The markets is focused on policy continuity. So, if markets get any cues from the election results, that could help. Then, on the global side, if any of the geopolitical uncertainties get addressed or get alleviated, that could help. If energy prices, especially oil prices, cool off, that could be helpful. The global cost of capital easing off further. We've seen that US yields, 10-year yields have come off from 5% to 4.5% kind of levels. If that trajectory continues, then, why not? The markets could continue to do well.
The second question is from the audience, from Shad. Sir, how is the chemical sector prospect for next few years?
Sure. So the chemical sector prospects for the next few years, to our mind is very good. Uh, Historically, what we've seen is that any large country that has grown well, has had a large chemical sector. We've seen that across the growth journeys of other countries in the world. India, has the talent pool, the infrastructure, the entrepreneurial drive, and now the opportunity in terms of China plus one or maybe Europe plus one as well, to kind of leverage the opportunity that is out there. So we believe that the chemical sector opportunity is quite significant, and Indian entrepreneurs are going to benefit from the same. What has happened in the chemical sector over the last few months or few quarters is that there has been an inventory destocking cycle, especially from China, and material has been maybe dumped or sold at lower prices across the world, which has impacted growth, margins, profitability. So there has been pain in the sector for a while. Could this pain last for some more time? The answer is yes, it could. But maybe we are towards the fag end of that pain, and for the longer term, next few years, we do definitely believe that the sectoral prospects are really bright.
The second question from Jay Mehta was that what does 15% margin of safety mean? Because from your
Sure.
PPT.
Sure. Let's say the way a stock is valued by us is that we do a long-term valuation of a stock. We try to model the long-term cash flows of the business. While modeling the long-term cash flows of the business, key elements would be, what is the kind of growth that the business is likely to deliver? What are the kind of margins that the business could achieve while delivering that growth? And what are the kind of investments that would be required to again achieve that growth? And whether it be in terms of working capital or it be in terms of fixed assets. And then we have an expected rate of return from these from the investment. So we kind of discount these cash flows over a long period of time, and then we arrive at what we believe is the fair value of the stock. Now, the fair value of a stock is not a permanent number; it is not a fixed number, and it is the number which is different from person to person, because each person will have his own evaluation of how the future is going to pan out for the economy, for the sector, and for that company in general. And then, when we say margin of safety, we basically look at that derived fair value versus the current price. And we believe that, we should have at least some margin of safety or some differential between the price at which we buy and the fair value of the stock.
Okay. Thank you, sir. And the second, moving on to the next question from Sanjay was that last 1 year, small or mid cap performed very well. Will it be right to invest in these caps for 2024 too?
Sure. This is a question which is there on everyone's mind. Unfortunately, in stock markets, generalizations do not work that well. While the small caps and mid caps as a space has done better, and from a valuation perspective, it does seem that there is relatively more comfort and perhaps greater returns to be made from large caps now than small caps and mid caps. But having said that, there are pockets within that larger bucket, which could still give phenomenal returns. And also it really depends on which are the sectors or companies that you are kind of invested in, right? So are there pockets within that small cap space where there is a lot of euphoria and frenzy? The answer is yes. Are there businesses which have delivered good growth and can continue to deliver good growth? The answer to that is also yes. So maybe the better way is that businesses where growth is still expected to continue, and where the valuations are still within reasonable ranges, or what one can think of, then one can still remain invested and there is money to be made. But yes, there are many other areas in the markets where there is a good deal of frenzy as well.
Okay. Okay. So more like a continuation question to that. How could an investor spot out the gems in the falling market condition? Like, how could he?
Sure. So see, a falling market condition, what generally happens is, either of two things could happen. One thing is, a person, depending on the mindset, could believe that there is a lot of opportunity, and sometimes the ticker or the tape of a falling market could also, frighten a person, and emotionally one starts to feel that, especially if one is invested, then one starts to feel that capital is getting eroded. Maybe it's a good time to sell. If one believes that there is an opportunity, then what we generally follow is that quality businesses eventually bounce back. So markets could fall due to, let's say, market issues. There could be generally a market sell-off. There could be a liquidity event. Let's say maybe FIIs are withdrawing money, just for as an example, or there could be some short-term event because of which markets correct, or there could be a market correction because of fundamental issues. Now, if those issues, market issues are relatively short-term or transitory in nature, fundamental issues could also be short-term, or might not have an impact for a long period of time. The way to evaluate a business at that point of time would be that whether the structural business model has been damaged. If that business model has not been damaged, then a falling market scenario is actually a good time to invest in stocks, because at that point of time valuation comfort increases and the likelihood of making money also obviously arises. So a few key pointers for that would be looking at stocks which have a good return on capital, looking at businesses that one believes will continue to grow, let's say 3 to 5 years down the line. So that is the other good parameter. The third good parameter to identify such stocks could be businesses wherein the stock prices has kind of fallen more. When a market corrects, obviously all stock prices do not fall at the same by the same quantum. Some could fall more than the others. There could be specific reasons for those fall. If one believes that such falls are transitory or short term in nature, then the desire to invest a greater amount in those kind of stocks should be higher. Sometimes correction in stock markets also leads to price correction in cyclical sectors. The cyclical sectors there could be short term cycles, or there could be longer term cycles as well. So for sectors that have longer term cycles, maybe it might not be a good idea to invest in them, because those cycles, if they last for a few years, one is likely to latch on to a falling knife. So the parameters that we kind of generally follow is that good return on capital, a good market position, that business should not be losing market share incrementally, that business should be able to grow its profit over let's say a 3-year kind of a time horizon, and the management of the business should be good. So these are some of the filters that can be used.
Okay. When you say that, the ASK growth portfolio has given over almost nearing 19% of CAGR since its inception. But I must say that last 5 years, returns were relatively low when compared to its benchmark in terms of alpha. So how do you see it, and what are the changes that incorporated in this portfolio?
Sure. No, that is true that, especially the last 1.5 years, have not been that good. Few key reasons for that. What we generally do, or what our investment kind of style is categorized as, high growth, high quality kind of investing style. Though we don't believe in, though we believe that there is only just one style of investing, but from a market parlance standpoint, our investing style is more like growth. While what has relatively done better in recent times has been, the value kind of investing. Secondly, our portfolios are generally more skewed towards large caps or mid caps or large mid caps. Though we don't select stocks based on market caps, this is what has done well in the market. Is what has done well in the market is actually small caps. While we are more invested in, let's say, large or mid caps. So that has also kind of relatively impacted performance. The third aspect is that some sectors of the economy maybe we were underrepresented in. So that has also impacted us. The changes that we've made is, see, we've not made any drastic changes to our philosophy. We continue to be long-term investors in high growth businesses which are high quality. We believe that ultimately over a period of time, such businesses create far more wealth. So our basic investment style hasn't changed. Obviously, what we've done is we've kind of slightly broadened the scope of our investments, and the sectors that we were present not in that much degree, we've kind of increased our representation in those sectors. So just to give you a few examples, let's say historically speaking, we were not, did not used to invest that much in government-owned businesses. And let's say the defense sector is a space wherein PSUs have a larger presence. But now we do own sectors, we do own a defense stock. So such are the kind of changes that we've made. We've also increased the exposure towards the capital goods of the investment side of the economy, wherein we believe that growth is likely to be higher for longer. And our portfolio was, let's say, relatively more skewed towards maybe the consumption side of the economy. So that kind of a shift have also been made. But the basic underlying principles and philosophy remains unchanged.
Okay, but when you talk about that, what will be your exit strategy? What will be, how do you determine to sell a growth stock or something, and what is the criteria that you look into?
Sure, Akshara, that's a great question, and it is always the most difficult part is to decide as to when to exit a stock, especially in a growing business. So, a few things that we look at. Firstly, is the stock overpriced or overvalued versus what our growth trajectory expectations are. If it is pricing in much more than what we believe it can deliver, we exit the stock. Secondly, if there is any moderation in the growth, or if we believe that there is any change in management strategy, which we believe is not going to lead them to deliver the growth numbers that we expect them to, or if there is a change in the business model, or if there is a change in the business landscape, if let's say new competition is coming in, or let's say the competition is more innovative than our investee company. So these are the things that we look at. What we also track closely are market shares. Is the business losing market share? Because the entire sector might be growing, but the business might continue to lose market share. And is the brand losing its salience? Is it not investing enough behind the business? So it is not only about growth today. What we are focused on is more the growth in the 3 to 5 year time horizon. So is the business doing enough to kind of benefit from the growth that is going to pan out in the space over the next 3 to 5 years? If not, then we will exit. So these are the things that we look at generally for deciding to exit a stock.
Okay, but okay, now I'm just asking something very completely opposite to it. More like when you said about stock picking, you said you'll be investing on a high quality business. Like, how do you quantify something called high quality business? What are the parameters that you check?
Sure. So, high quality for us is a good return on capital. So basically, if one is investing 100 rupees in the business, then the minimum return on capital that we expect is around 25%. Then what we look at is what are the competitive advantage of that business. So that business might be delivering a 20%, 5% kind of a return on capital today, but whether it will continue to deliver that return for the next 3 to 5 years, we need to be sure that there is a good moat in that business. And it'll be great if that moat is actually increasing over a period of time. So, that is obviously an assessment that we do, which defines a high quality business. And generally speaking, leadership businesses can be built only if the competitive advantage is big to start off, and then it continues to grow as well. We also look at, high quality business will generally have a good balance sheet, because if they are delivering 25% kind of return on capital, they should be able to generate free cash, and they should be able to fund their own growth.
Yeah.
So the next thing would be that it would generally be having a good quality management, because the business, this is an important parameter of a high quality business. The management would be having a good, execution track record, vision, good character. All of these are key elements of a high quality business.
Okay, so due to time constraint, let me combine two questions and ask you. The first question is that because when you say it is a very concentrated portfolio of around 20-25 stocks, if I'm not wrong, from your PPT that you said that it's a very concentrated portfolio. So how often do you rebalance your portfolio, and how about the portfolio churning frequency, and how often do you take cash flows? All are similar questions.
Sure. So the last question first, we actually do not take cash calls. We are not, let's say, top-down investors. We are more bottoms-up investors. So we invest in businesses. We do not take market calls. Obviously, there could be some cash in the portfolio because, we are exiting some stock or entering some stock or waiting for a better price point, etc., etc. But generally speaking, we do not take cash calls at all. We don't take market calls, essentially. The churn in the portfolio, which was your second question, is generally about 25% or so ballpark. We would like to invest and remain invested over a long period of time. And hence the churn ratios for us should be relatively lower compared to the general market levels per se. Obviously, depending on certain market conditions, it could go up and down. But broadly speaking, that is the ballpark around which we are. Your first question, how do we decide to sell a stock, and when do we decide to rebalance? Whenever there is a good opportunity relative to whatever we own, we would like to rebalance. So that is A. B, whenever we believe that a portfolio has become a very high weight, a stock has become a very high weight in the portfolio, then from a risk management perspective, we would like to rebalance. So let's say if we own 25 stocks as an example, and so there is one stock, so let's say on an average, there should be a 4% weight in a stock. Let's say one stock has become an 8% weight because there has been good price appreciation. Then from a risk management perspective, we would like to cut weight in that stock and add that weight to some of the lower weighted stocks in the portfolio, more from a risk management perspective, even if we believe that the stock will continue to do well. So that is when the rebalancing will happen. A rebalancing will also happen if we realize that we've made a mistake. If
Any
we bought a stock.
Any example that you want to share?
So let's say, one of the examples is, let's say, we used to own a stock, Aarti Industries. Aarti Industries is a very strong chemicals player, and it had exports to Europe. Those exports got impacted due to the Russia-Ukraine conflict. We obviously had not expected the war to start and then for it to last that long. So we waited for a while. but we realized that the business could take longer to turn around than we had originally anticipated. Obviously, this is a macro condition. The business might, still continues to maybe remain solid, but we didn't have visibility as to when that situation is going to improve, and hence we decided to, exit the stock. So, there will be such situations when, there will be a rebalancing. There could also be a rebalancing when we realize when, there is any change in our assessment of the business model, the management, the opportunity landscape, the business landscape, the competitive landscape. Those are situations when we will change. Or let's say, there is a stock price. We have a stock in the portfolio and the stock price actually comes down. We believe that, there's an opportunity to add. Then, we will add weight to that stock, and you take out the weight from some other stock which has done very well, and, the weight of that stock has become excessive in the portfolio. So portfolio rebalancing is a continuous exercise. We evaluate our positions on a very regular basis, and whenever any of these conditions arise, then we go ahead and rebalance.
Okay, sir. So moving on to the last but the question is that what type of investors do you believe is more suitable for this ASK growth portfolio?
Sure. So investors that have a long-term time horizon, they have a certain pool of money which they would like to remain invested in equity markets, for a long period of time. Let's say loosely speaking, for which they do not foresee any, need to liquidate, at least as of now, right? So let's say whatever one says, generally a core equity portfolio. So if any person has a core equity portfolio, he should look at ASK's growth portfolio, because ASK growth portfolio is focused on investing in high quality, high growth businesses that will create wealth over a long period of time. We would generally be investing in businesses that are leaders in their respective segments, which have top-notch managements, which generally established track record, with no constraints on any sector or any market cap. So, we would be able to leverage on any opportunity which is available.
So what is the ideal investment horizon for this growth portfolio?
So, generally speaking, when we speak about the long term, it is more like 5 years, but in these times, in an impatient world, 5 years is perceived to be a really long time. So, we generally say maybe 3 to 5 years is a time horizon which one should look at while investing in this portfolio.
Okay, sir. Thank you. With that, we come to the end of the session, and thank you for your time. Of course, there are a lot of questions which I couldn't take it due to time constraint, but I would request the participants or attendees to post them on events at PMS Bazaar. And we will take it, and we request you to start some time for these questions and answer them, so that we get back to the participants about the answers. Thank you, sir. Thank you for that. And I would also like to thank the participants who were patient on a very Friday evening to listen to this. Thank you, sir.
Thank you so much, everyone, for your time. Thanks a lot, Akshara. Have a good weekend, everyone. Thanks a lot.